So I want to do a quick video to look at how the balance sheet runoff and interest rate hikes has turned out to affect the crypto and stock market. So if you remember, uh, I have a playlist for this kind of stuff and I have a video where I talked about it almost a year ago now. I think it was around mid-January. So you look at the balance sheet here. Well, if you got any questions about what we're talking about, go through this playlist and you'll see the videos break down what we're talking about. The balance sheet here, you can see that it started to run off. And if we look at interest rates here, you can see that interest rates shot up. This was the result. This happened because of trying to fight inflation. So you just look at how sectors have performed, and this is just finviz.com. You go there and then click on groups, and you will see this and scroll down to the bottom. You see year to date relative performance. You can see that pretty much everything's been getting smoked except for energy, and utilities has fared pretty well. So just looking at that, you understand what we talked about in this playlist and in these videos is how raising rates is bad for stocks in general. Well, I'll say aggressively raising rates and aggressively running off the balance sheet is bad for it is very bad for speculative stocks. Some stocks, some sectors can handle it better than others, and some just kind of are flat. But one thing that I had predicted to do well was XLF. I felt like since we were raising rates that the banks would benefit the most from it. And I mean it hadn't done anything spectacular, so I was pretty off there. And something we'll look at crypto like Bitcoin. And if you're wondering why it sold off the way it did, like I said before, when I talked about it in January, we referenced 2017 timeframe when you had that sell off. It was because the Fed was starting to raise rates. So basically, we just got the same thing happening here. Turns out it was an M double top uh, on the chart, but you got like a really nasty sell off, and just from that 69,000 peak, we're down like 75% right now. So that's kind of what happens to markets. If you look at something else that's speculative, like the ARC fund, I mean, just going from this high area from February 2021 down almost 80%. So if you don't understand what balance sheet runoff and how interest rates affect markets, then this is the kind of stuff that you kind of leaving yourself susceptible to. And you just look at the S&P 500 since those highs late about a year ago, we're down almost 20% right now, and it has been pretty bad this year. Um, we're looking at a potential bearish engulfing type setup, even if it doesn't go bearish engulfing. I mean, it's pretty bad. And with QQQ, I mean, unless something crazy happened, this is going bearish engulfing. You see how bad the tech sector has been hit. So the tech sector is more susceptible to rate hikes than like the S&P 500, or I'll say technology stocks. And the QQQ is more tech heavy than the S&P 500. So this got hit harder. And I mean, you can see how rates have affected these kind of things. But if you look at like energy, this has just gone crazy this year, up over 50%. Of course, the invasion with Russia, Ukraine, and stuff was a pretty big catalyst that nobody really knew was going to happen coming into this year. But you just got to keep up with the market and understand that really people come up with a lot of um, analyses and all this stuff about why this did that and why this did that. And it really just boils down to balance the Fed, man. Like that's the major narrative. Like that's the big narrative. Everything else is just like industry specific headlines, and that main narrative is always going to outweigh those minor headlines that you got going on. When when you find a catalyst and it does move a stock, you typically find that it either went and flowed with that major headline of what the Fed was doing, or if it was a counter trend move and the Fed hadn't changed its perspective or stance on monetary policy, then it probably was just going to be like corrective price action. So I will say, pointing out this rally we had off the summer lows, it was shocking to me, and I got smoked on it because I did not think that the market could really do that. Because I'm like, there is not a Fed pivot, and even if it was, inflation would still get worse. It's just a counter trend move, just corrective price action. The stock market won't go straight up, usually won't go straight up or straight down, and you just got to be aware of that stuff. Even when stuff is bad, sometimes the market will get out of whack, out of sync, and start to try to correct itself. Um, but you see, we still got a sequence of higher or lower highs and lower lows. And I will say, looking at 2022, the first half of this year, it was like the fourth worst start to a year in history. So, hindsight, of course, put that in perspective. We had the first half of the year right here. It makes sense to see some kind of bounce. And you just look at bonds, TLT, these were having um, some of the, like, I think it was the first time in history that it had gone down for an X amount of months straight or something like that. Maybe that was gold. Gold had gold had gone down for like 7, 8 months straight for the first time ever. TLT was having like the worst first half performance like ever type stuff. Top three, top four, top five, something like that. So you see what these rate hikes have done to the market. Like bond market, stock market, crypto market, everything has been getting hit. So it ain't really been nowhere safe to run. And we've seen one of the worst performances from a 60-40 portfolio being 60% stocks, 40% bonds. You got to think, this is supposed to be one of the safest assets to run to. You can't run here. What can you run? You feel what I'm saying? And this ain't shaping up to be nothing too pretty on the monthly rate here. We'll see how the month finishes, but this could get bad, man. So um, I would say keep TLT on your watch list going into 2023. Sometime in 2023, you should have a good setup. I'm not saying nothing about which way it's going. I'm just saying we got some tightening going on here. Um, I would say keep XLF on your watch list. We got some nice tightening going on here. And I would say just you got to learn how to trade, um, even around the narratives. And sometimes you got to respect those counter trend moves because market will try to correct for extended periods of time. And that's pretty much it, man. I would just say, man, just please, they say don't fight the Fed. And then they just start trying to fight the Fed when we have a tightening Fed. I just say respect the Fed, man. Understand what they're doing and just follow the money. Do what they're doing. Don't listen to what they're saying because I think the biggest thing that I've learned this year is that for every seller, there needs to be a buyer. And if they're telling us the full truth, none of us would want to be buyers. The average retail trader or average retail investor would not want to be a buyer. So if they trying to offload billions and billions and billions of shares, they're going to push these narratives that everything is okay, that things are doing well. They're going to make price action look like everything is well. Because, I mean, they run the market really. So be on the lookout for price manipulation. Um, when the storages don't make sense, just I'm not going to say be skeptical, but be skeptical. And I will just refer to this setup here with NQ. They set this up beautifully. This is going to be the last piece that I talk about here, and then we'll dip out. But you got this setup here where they went range mount. Now, okay, let's go back. So this is the summertime, like we talked about, and you got a setup here. Range one that I got identified here looks exactly like this. Well, very similar to this. A lot of people missed this. Nobody was kind of really expecting this. This move higher was crazy. So they come back down right at the same price area, set it up, very similar outlook. Inflation data comes out and it's still high. I think it was like, what, 7.7% CPI or 7.5 or something. But they push this narrative that, oh, it's coming down, so this is good. Then they pump it. This is CPI day right here. So they pump it as if we're about to have a breakout, similar to how we had back in the summertime. Then we just do nothing for like an entire month, right? CPI comes out again December 13th, and they start to pump it. And look how we had got right over these high points, these recent high points. Everybody and their mama starting to think, yo, we finna run. We already knew something suspect was going on because we knew the narrative didn't make sense. Price action was starting to not make sense too. And they just dumped it. I mean, if you look at the 2-day chart, that's a very nasty bearish engulfing. And we caught this whole move down. So it just shows the progress that we've been having, just learning from mistakes, past mistakes, and all that kind of stuff, and just realizing that they will try to. I'm not saying market psychology or news is everything, but sometimes it really will matter because this whole rally was based on the idea of a Fed pivot, which didn't even make sense. But at the time, we were having the worst first half of the year, so a bounce in corrective activity did make sense. So that's one situation where the narrative was wrong, but it did fit the scheme of the price action, which was correcting at the time. So I'm not saying that the news and the narrative will always mesh with the price action go hand in hand, but sometimes in situations like this, you just want to be real suspect and be careful. And sometimes it's really just best to sit down and wait. So going into 2023, I think it could be a tough year if we get these yearly candles like this. And I would just say be on the watch out for stuff because, I'm sorry, the last thing we'll talk about, one of the darlings. I mean, it's down like 69% off its highs. Yes, it's still up a lot from its COVID lows, pandemic lows, but I just want to stress the importance of being careful next year, understanding what good dip buying opportunities are, understanding the difference between a trade and a long-term investment, and utilizing a stop loss even on your long-term investment. You always can get back in. Even if you miss a 5-10% move, at least now you know where you have strong support at. Don't just go guessing, buying red candles, buying pullbacks. That buy the dip narrative, in my belief, is something that they push so that they know they always got somebody to sell to. That's just my belief. I think it's a crazy thing that they've set up for decades and decades, but that's just how markets work. And just be real careful next year, man, and understand what you're buying. Like really understand what you're buying, and please respect the Fed and try to tune out the noise from the people on TV because they just be bugging sometimes. But that's it, man. Hope y'all enjoy. Probably be back in a couple of weeks or a couple of months. If you're interested in joining our mentorship program or Discord, go to my Instagram, click the link in my bio, 6fatdaddy9. I'll catch y'all later. I wish y'all the best. And I hope you've had a good year, and I hope next year goes even better for you. I'll catch y'all later.